All right, so you've been in the game for a while. You're a long-term holder, a hodler, right? You've been patiently watching your portfolio, things like Bitcoin, Ethereum, Chainlink, and seeing them grow. But now, you're feeling like it's time for the next level. You want to go from just holding on to actively hunting for those perfect moments to buy. Okay, let's get into it. Let's build a framework that helps you do exactly that.
And you know, we're not the only ones thinking this way. The legendary investor Paul Tudor Jones, he absolutely nailed it back in 2020. He was talking about what he called the great monetary inflation. And he said, look, in a world where regular money is losing value, your best move is to bet on the fastest horse. And for him, that horse was Bitcoin. This really sets the stage for why understanding these assets is more important than ever.
Ah, yes. That's the million-dollar question, isn't it? I mean, knowing what you want to buy is one part of the equation, but knowing when to actually pull the trigger, that's a whole different ballgame. Answering this one question is the entire reason we're doing this explainer. We're going to build a strategy with multiple layers, from the huge big picture stuff all the way down to the nitty-gritty of the daily price chart.
So first things first, let's start with the macro view. Before you even dream of looking at a price chart, you've got to know which way the wind is blowing in the wider economy. Seriously, it's like checking the weather forecast before you set sail. Is it sunny and calm out there, or is there a massive storm brewing just over the horizon?
This right here shows the two main weather patterns created by central banks. Think of quantitative easing, QE, as pure sunshine. The central bank is pumping a ton of money into the system, which makes investors feel brave and much more willing to buy speculative assets, like crypto. Now, the flip side is quantitative tightening, or QT. That's the storm cloud. It sucks that money out, making investors get nervous and run for safer assets. Just understanding if we're in a QE or QT cycle is your first huge clue. And this really gets to the heart of the long-term case for these assets. You've got governments all over the world racking up trillions in debt, and as they print more and more money to pay for it all, the long-term value of those currencies gets called into question. This is what's pushing big, serious institutions to look for hedges, things like gold and, you guessed it, Bitcoin, which nobody can just print more of. Okay, so we've checked the weather. It looks favorable for our journey. Now it's time to inspect the ship itself. This is where fundamental analysis comes in. We're going to dig into the actual technology, the team behind it, and the economics of a project to figure out if it's built to last. This is how we decide what to buy.
The key here is to have a system. You can't just jump into a coin because of some hype you saw online. You need a process. You start with the white paper. That's the project's constitution. Then you look into the team. Are they for real? Do they know what they're doing? Next, you got to dive deep into the tokenomics. We'll get to that in just a sec. And finally, you have to get a feel for the community. A strong, active community is almost always a sign of a healthy project.
Let's make this a little more concrete. This is the table of contents from a recent white paper for Chainlink. Just look at how much info is in there. It's got everything. Details about the project, the people running it, all the potential risks, and the tech itself. You don't have to be some coding genius to understand it. You're just looking for things to be clear, professional, and for there to be a real vision for what problem they're trying to solve.
And that brings us to this super important concept, tokenomics. You can think of it as the economic blueprint for a crypto asset. Is the supply fixed, like Bitcoin's 21 million, which creates scarcity? Or can they just keep printing more? How were the tokens handed out at the beginning? Was it fair, or did a few insiders get most of them? And maybe most importantly, what's the token's utility? Does it actually have a purpose in the network? You have to answer these questions to get a handle on its long-term potential.
Okay, deep breath. We've looked at the big economic picture, and we've dug into the fundamentals of a project. Now we get to the final and maybe the most exciting piece of the puzzle, technical analysis. This is the art and the science of reading price charts to figure out precisely when it's time to make our move. So what is technical analysis really? Well, at its core, TA is the study of market psychology. The whole idea is that every piece of known information, all the news, the fundamentals we just talked about, global events, everything, is already factored into the price you see on the screen. So by studying that price action and the trading volume, what we're really doing is studying the collective mind of the market. The entire field of technical analysis is built on these three pretty simple but really powerful ideas. First, like we just said, the market discounts everything. It's all in the price. Second, prices don't just bounce around randomly. They move in trends. They go up, they go down, or they go sideways. Our job is to figure out which trend we're in.
And third, history repeats itself. And why does it repeat? Because human psychology, good old fear and greed, doesn't really change over time. And that leads to chart patterns we can recognize.
All right, let's start building your toolkits. We're going to begin with the absolute basics, the foundational concepts that every single chart analyst, from a complete beginner to a seasoned pro, uses every single day. This is the cornerstone of all chart analysis, support and resistance. Just look at this Bitcoin chart. Support is a price level where buyers have shown up time and time again, creating a kind of floor under the price. Resistance is the exact opposite. It's a ceiling where sellers tend to show up and take profits. Just being able to spot these zones on a chart gives you a basic map of where the market might turn. Okay, now let's zoom in on the individual candlesticks, because each one tells a little story. A hammer, for instance, with that long wick at the bottom. That tells you sellers tried to push the price way down, but buyers came roaring back and took control. That's a bullish sign. Then you have a doji, which looks like a little plus sign. That means total indecision. Neither buyers nor sellers are winning, and it often means a trend is running out of gas.
Awesome. You've now got the basics of market structure and how to read a candle. Now let's add a couple of powerful indicators to our toolbox. Think of these like the gauges on your car's dashboard. They help you measure the health and momentum of the current trend. First up is the RSI, the Relative Strength Index. This little tool measures momentum on a simple scale from 0 to 100. The classic way to use it is to look for the extremes. If you see a reading way up above 70, it suggests the market is overbought. It's gotten too hot, too fast, and might need to cool off. And if it's down below 30, that suggests it's oversold and could be due for a bounce. It's a fantastic way to see when a trend might be getting tired.
Next up, we've got the MACD. This one is all about following the trend. Now, the easiest way to use it is to just watch for these two lines to cross. When that faster blue line crosses up and over the slower orange line, that's what we call a bullish crossover. It's a signal that helps confirm that upward momentum is building. It's a great tool for adding a little more confidence to your ideas. Okay, this is where it all clicks. We've collected all these different tools. Now we're going to learn how to use them all together at the same time. This is what separates the beginners from the experts. It's the art of finding confluence, where multiple signals all point in the same direction. So what is this confluence thing I keep talking about? It's really simple. It's the idea that a signal to buy or sell is way more powerful when it's confirmed by a bunch of different independent tools. So instead of just relying on one thing, you're building a case, like a detective. You're looking for that one spot on the chart where a support level, a candlestick pattern, and an indicator like the RSI are all screaming the same thing at you.
This slide lays out exactly how an expert puts it all together. Just picture this. First, you spot a major historical support level on the chart. Then, you notice that a key Fibonacci level also lines up right there. The price then drifts down to that exact zone and forms a perfect bullish hammer candle. At the same time, you glance down at your RSI and see it's way down in oversold territory. And to top it all off, the very next day, the price moves up on a huge spike in volume. That's 1, 2, 3, 4, 5 different signals all aligning in one place. That, my friends, is a high-confidence buy setup.
So when you step back from it all, what is technical analysis really? Is it some kind of hard science that can actually predict the future? Or is it more like, I don't know, astrology for traders, a self-fulfilling prophecy that only works because millions of people are all looking at the same lines on a chart? Honestly, it's a debate that has been going on forever. But here's what I think is the real answer. The charts don't have a magic crystal ball. They can't tell you the future. But what they can do, and what they do incredibly well, is give you a real-time window into the collective psychology of the market. It's the constant tug-of-war between fear and greed right there on your screen. The charts show you where the big money is buying and selling. The patterns are just reflections of predictable human behavior. So the real question isn't whether the charts are right or wrong. The question is, are you listening to the story they're telling?